one of the strategies that we have is, and also I need to tell you that I'm giving you a very big overview because we don't have a lot of time today, and also I'd like you to put some questions already as I go because you may not remember all of them. So take notes and then put down your questions. But I'm going to give you kind of an overview of what the different strategies we focus on. So one of the big strategies we do, which usually apply to, I will say, people who have, 7-8 figures tax income burden, is the Phoenix Capital Incorporation, with the possibility of providing 85 to 90% liquidity for those with recent or upcoming capital gains or large lump sum ordinary income events. And this involves creations of, and I can only share part of what that is, one, because I am not the expert, and second, because some of it is proprietary. All of the strategies that we use are compliant. We work, in collaboration with banks such as JP Morgan. We have white paper, everything is compliant. We work really side by side with the IRS. So that's something that's very important to know. But if you have a really large tax burden, this is one way you can mitigate just about all of the burden that you have by reinvesting basically into creation of new companies and upcoming companies. And again, I do have more information about this. And I will.
Question, Juliana,
yes.
Just to clarify. So if I have a client, because I have some clients, and they're getting ready to sell a company that they grew for 10, 15 years, and each one's going to get about $15 million through this merger and acquisition, M&A. So you're talking about this as if you're going to maybe sell a business and then you're going to get a large kind of gain because you're selling a business. Strategically, before that transaction occurs, it's good to get with you guys.
Absolutely. And you said the key word here is before anything occurs, you want to find out what are your options. And this is not an option that is well known. Even with experts, in merger and acquisition or valuation, or so it's important to talk to people who know how to do this, to advisors and to tax strategy experts, not just tax experts, but tax strategies, because it's different. Yeah. Thank you. That's a great question.
And Juliana, too, just to give context, some more context for people. So when you talk about a large lump sum ordinary income event, because for those of us who are investors or in finance, we recognize a capital gain event. What would be a lump sum ordinary income event? And also, what's large?
Okay, so with this particular strategy, I would say you would need to have a burden for this strategy to make sense. You would have to have a tax burden that's near to 5 million. Okay. 5 million or above.
Okay, so very large. Okay.
Very large, yes.
Okay.
Otherwise, the next one is it's a strategy that fits in more to mid-market to low market tax burden.
Okay, thank you.
That's I'm starting with the big one.
Yeah. No, it's good. It's good to know the context for people, because sometimes when you sell a business, like Jennifer was saying, that's a big capital. That's a really big capital event. And other times you might have some liquidity coming back that's $100,000, which is still a lot of money, but obviously really different. So I just wanted to make sure that we provided that context for people. So thank you.
Thank you. No, that's an excellent question. Please jump in, because like I said, I'm giving you the outline here. And so if you have questions, otherwise it would have been like a 2-hour presentation, which we don't have. So I do want to leave room for a lot of questions after on each of the strategies. Now, this one, the art of taxes, will fit into if you have less, you do have, maybe ordinary or extraordinary capital gain, but it fits for a wider range of people. So the art of taxes is providing an opportunity to eliminate up to 50% of your annual taxable income in collaboration with a nationally and internationally renowned antique and fine art gallery. So B10 Capital has partnered with Anthony's Fine Arts an antique gallery, which is in Salt Lake City. If you look at the building on the top left, that's an old building from, I believe, the 50s, or that sits in the heart of Salt Lake City. And Anthony Christensen, the founder, acquired this gallery about 30 years ago. And he's a great collector, traveling the world and finding pieces of art from all era of time. Mostly it's the Western world, a lot of European, a lot of French, a lot of German. Micah Christensen, his son, is a very, very knowledgeable art historian. So he studied at Sotheby's, got his PhD in London. He also consults with the Vatican to appraise, to value, art, and to, figure out if it's real. Like he's got all the credential. In fact, for those of you who are in Texas or close or want to come, I will have 2 or 3 events this year around this particular tax strategy where I will bring Micah in and he will present a little bit more. Now, why is this significant? Because I'm guessing some of you or most of you have heard of this strategy of being able to donate, art or documents to universities, to museums, to hospital in order to then deduct it from your taxes. And yes, that is a thing, and people do it all the time. Now, not too many people know how to do it because it's not as easy as it sounds. It's not just I go and buy a piece of art and go give it to my friend and then I can deduct it from, my taxes. It doesn't work like that. The IRS is very particular about how this strategy is done. You have to have the proper piece, either art or documents, and you have to have the proper match with the receiver of that piece of art or document. So that has to be vetted by the IRS. There is a whole process. So we have figured out how to do it and how to do it properly. And we know all the people at the IRS who come in value. Now, because we have had this relationship for years with this gallery, we basically have a catalog of items that you can pick from. And with this, you don't have to have made, 5 million. You don't have to have a 5 million in tax burden in order to use this strategy. You can go as low. It goes as low as $25,000, I believe, now that we have for boxes of documents, old documents that a university may want for its PhD program, and you can accumulate those. You can. So it goes from $25,000 to millions of dollars of pieces of art. One of the largest piece we were able to sell, what its valuation was at $15 million for a huge mural, the crossing of the Delaware, that was purchased. But now the trick is, it's not a trick. What we have with that relationship is that we can obtain those items or pieces of art at a discounted price because we have that relationship. And something that not too many people know, and it's not hidden because, again, it's somewhere in the 7,000 pages tax code. It's laying there. But if you hold on to something for a year and a day, the IRS is not going to care about the receipt. The IRS will send someone to appraise the piece of art or documents to see its real value and to know for themselves what it's worth. Now, what happens with that is that the object does appraise. And also, if you work with us, not to sell here, but we do get these items at a discounted price, sometimes 2, 3, 4 times less than its value. And so if you're patient and you wait a year and a day, instead of, let's say you buy, 2 boxes for $50,000, I'm going to take a small amount, and you could deduct that from your taxes that year and then attach the receipt to your tax return. But if you wait a year and a couple of days, then your receipt won't matter. The IRS will come and value that product, and it will be worth 4 times what you paid for. And that's what you can then deduct from your taxes. So that's something that we've been doing for several years, and that people come, back over and over to use that strategy. And like I said, it can be a minimal amount or a bigger amount. right? Yes. Out of
So
the
Julianne, I was going to ask, I think this is phenomenal. Like I think this is so cool. But how would one, and I just wanted to understand, you were saying that people would make donations. Is this nationwide? And does this catalog have, let's say, multiple different options for maybe somebody who wants to donate to something that's near and dear to their heart versus just taking the deduction, right? Because at the end of the day, so how do you match the intent with the item, I suppose?
That is a great question, because and the IRS will never, you can never come out like that. I want to buy this because I want a tax deduction. That it has to be of value. Like, you have to provide value to the person or institution, and that is why it has to match. You cannot give, those documents to anyone or any university. It has to match that program that absolutely needs it. Same with the art. You can't just give that mural to anyone or any museum. It has to match. It has to match the party that needs the object for specific reason, and all of that is very, very detailed. And so the idea is to have a win-win-win situation on all sides. The university is happy to receive it. You have made, you have helped, elevate an institution or a program or something like that. So the intention have to be right when you do that strategy. So I don't know if that answered your question.
Oh, that's exactly. Yeah, that was my question. What if somebody has an institution that isn't, let's say, listed? Because I'm imagining this is a directory of sorts. If somebody brings one, how does that work? Like, if I have one where I really want to donate something to them and it's really meaningful for me, but they're not part of your program.
So they will help you to, so when I say they, it's, so the CEO is very involved. The CEO of Beaton Capital is very involved with strategy because he's been doing it for a long time, and the CEO as well. Anthony Christensen, Micah Christensen, will help you know how to, have that process in place. They have all the details for that.
Okay. Oh, that's great. So that opens up options for those of us that are doing, it's a different form of philanthropy.
Yes, exactly.
Different tax benefit than, just making donations. So
yes, I hope one of you, Jennifer, Lynn, or Adapia, are keeping track of time, because I have no watch. So
we're okay.
Please tell me. I have about 4 other strategies to go. So tell me when to move on.
Okay. Please. Just to break this down super clear for myself. This is, I buy a piece of art, then I donate the piece of art, and I get a tax deduction for donating it to somebody who needed it.
Yeah, because it's just like any donation, right? The donation strategy is just very well known. It can be just about anything. It doesn't have to be art. What is different with this is the fact that you are giving objects that are appraising year over year. I mean, you could even hold on to whatever piece of art for 5-10 years if you wanted to, and it would appraise. But now it really depends on when you want to give it, But if you wait at least a year and a day, that's when the receipt doesn't matter anymore. If you do it the same year, you would have to show the receipt, and it would be the exact, your deduction would be exactly what you paid. But if you wait, then it will be 2, 3, 4 times, sometimes more than what you paid for.
Yeah. So it's art donation plus buy low, sell high.
Yep. Absolutely. Okay. Absolutely. You got it. Any other questions? I don't know if people are writing in the chat. Maybe can someone tell me about?
Yeah, there is a question for Rowena, and
with the screen.
Rowena said, "Does this company deal with NFTs?" So wondering if you deal with non-fungible tokens.
Not at this moment. There's a whole section because it's very much unregulated right now, and we are working on it when it comes to cryptocurrency and NFTs and all that modern transactional and non-fungible. We are working on it. So right now we're not doing anything of that nature with this, and it could come in the future, like in the next year or two, because we are actively working. We want to be participant in actually creating the guidelines around taxation around NFTs and cryptocurrency, because it's right now, actually, there are guidelines, but there are no hard regulations. So we want to be in the forefront of that as well.
Okay.
Okay,
And I think we can move on because it's 9:30.
Yes.
And I know we're out of time.
And when do we stop? I might need to put a timer here.
Oh, like 9:45, 9:50. We want to have Q&A.
Okay, so about 14
20
minutes.
Yeah, 14
Okay, 20 minutes. Okay, I'll put my timer so I can see how.
Okay.
There you go. So, all right, next we have cost segregation in real estate. So this is I'm going to go into the tax credits, which you may have heard of or not, or you may not know how it's done. I'm not going to go into the intricate details. We have experts in our team who do just that one strategy. Like all of the strategies that I'm showing you, we have experts who do just that. So you can ask all the questions. But so cost segregation for real estate has to do if you own commercial real estate or multifamily type real estate. We can look at tax credits that comes with energy efficiency or depreciation ahead of time. And that's what cost segregation is. So the possibility to leverage your real estate interest by reducing, current income tax liabilities through engineering-based tax saving tool that accelerate depreciation. Sometimes people want to wait, the 10 years or 12 years. And sometimes they want to do it ahead of time to re-inject capital into their companies. And so we can look into that. Then we have, is there any questions? I just really quickly browsed over that.
No, we can answer questions in the last part of the.
Okay, perfect. So with the research and development tax credit, I think more of you would be familiar with this. If your business develops, innovates, or refines a product or service, you likely qualify for the federal government R&D, research and development tax credit incentive. This program can recapture 13 to 17 cents on the dollar. So let's say if you invested $500,000 into developing a product before it's out or service, just testing and creating things, seeing what works all the way up until it's out to be give service to the public, you would get $65,000 to $85,000 back on your investment of that. And that's not taxable. It's just a check in the mail for what you invested. And as I've spoken to literally hundreds of entrepreneurs and business owners, mostly last year, I realized that not many know about this. Not many know that they can get money back for what they've developed, and it really touches a lot of industries. Now, the tricky part is how well you've kept track of what you've spent and the time that you spent, because it's not just the money, it's the money and the time that is there. There's a special calculation for that. The government came in the 1980s with incentives, so people would be creative, people would be innovating, and that's where this tax credit came about. And also, sometimes accountants kind of know about this, but they don't do it well. We have gone back and done the work for people who thought they had done it, but they did it wrong. And so we were able to get more money for them. And with this, you can also go back 2-3 years. Even if you've done it, let's say you just did it, but you didn't do it the previous years, you can go back up to 3 years to see if you got all your credits for that. And we take care of the refiling and whatnot. Like he's our R&D guy. He's really, really good. Like he does this really well.
So Julia,
yes.
On this one, then, can you give us some examples of what is R&D? Like, is a startup R&D? Like what
does it consist of?
Yeah.
So research and development exit. Let me not. Tell me if, can you still see my screen if I go like this, or is it just reduced? Hold on, let me not do that. So with the research and development tax credit, it touches a lot of different it touches a lot of different companies or in industries. And so are you asking which industry qualifies for this, or what the process entails? Okay.
What activities would qualify?
So, for example, I worked with a developer here in Texas, and so he builds homes. He builds townhomes, and so for him, it would be the first model that he would create. He could get R&D from that. Why? Because he used new material. He tried a little bit. You need to have some kind of prototype activity to build and create. So the material that he used, the time that he used to create that prototype would count as R&D, because it wasn't service to the public. Even if, to take an example who's a little bit more complicated, but you could still do it. If you were a cook and you try a bunch of different recipes before you put them on the menu, that would qualify as R&D too, if you kept good track of, all the ingredients and, that you had to buy in order to try that. With technology, if you have a new software and you had to invest into A/B testing and trial and error and all of these different things that you do to ensure that the product is going to be optimal when you launch. Like everything you do before a launch, all the money and the time that you put in, there has to be some uncertainty in the mix, when you go through the process, and there has to be A/B testing, all these kind of things. Does that answer your question?
Yeah, no, it's really helpful. I'm sure that there's myriad examples.
Yes.
Because everyone has, we have a lot of business owners on the call today, and so I'm sure that they're all spinning, thinking is, if I'm launching a new course, for example, for a service, if I'm, everyone's always launching something. So I think that would probably be top of mind.
Absolutely. And so as long as there is some money invested into developing the product, and you are able to show that, and this I want the people maybe who are new into the process or hear this for the first time, a mistake that a lot of people do. A lot of times when they start a business or they start doing this, they don't keep good records of what they've spent, and they don't keep record of the time they spent, or they don't remember. So if you haven't done it yet, that's something I would definitely encourage you to do, is keep track of every, receipts and email where you're talking to developer to come in, or even hiring people to help you develop. That can also come into the research and development. So keep really good track of all of that, because that's what our R&D expert is going to ask you, is to provide all of that, and then he will create a file that shows that you put the money and the time into what you're developing.
That's great. Thank you. We do have one last question on this for you, and then we can move on. Is does big pharma and do startup biotech companies utilize this strategy? Because they're, so much of that is R&D.
200%.
Yes. not 100, 200.
Absolutely. Okay. And usually that's what people think of, when they think research and development, they think, biotech and, medical and all of that, which is true, but it's not just that. And that's where I was surprised too. The first time, I went in depth into it, I was like, wow, I did think that it was mostly applicable to, medical and pharma and, bio and all of that. So. But no, it's wider.
For the rest of us.
Manufacturer. If you are or know manufacturers, or if you work with some very closely, definitely bring them to the table. Yeah. Yes, and then at the end you'll tell me how much I can say that we can do, because I really want to give you information. I'm not selling anything. In fact, I like to say that we find the money for you, right? We don't, I'm not, and so I tell me if I sound like
no, this is great. That's why I was asking questions. That's why I was asking, asking these questions. This is really helpful. I know that you have one or two more that are business related, right?
Yes. So research and development tax credit. So, and then this is actually the last one. So we'll have a lot of time for the questions. Okay. So this is the lowest hanging fruit right now, which I'm sure you all heard of, the employee retention tax credit, and there's a lot of confusion. I mean, there's a lot of opportunists out there who just, are trying to get money out of that, which, yes, it's still in place. I say for us, it's our lowest hanging fruit. It could go out tomorrow. That's not going to put us out of business. But yes, it's still applicable. There is a lot of confusion because this is COVID related, 2020 and 2021. And okay, I'm going to read this. So the ERC can provide up to $26,000 per employee for U.S. companies that have maintained operations and been negatively impacted financially and or operationally through the global COVID pandemic in the years 2020 and 2021. So this is still applicable. This still works. It still works if you received PPP loans, 1 or 2. What happens then is that we deduct specifically and exactly 60% of the money that you received. Now, if you have 20 or more W-2 employees, very important, they have to be W-2s, not 1099. There is still a lot of times money on the table. So you want to explore that. If your accountant hasn't looked into it, just ask more questions. We have helped so many companies with this, the past couple of years. I think we've given back close to 100 million to different companies because they were confused because the IRS was like, yes, you can, no, you can, this, that, and people don't follow very closely, but we do. Every change of regulations, we follow very, very closely. And so, so we still do ERC quite a bit as well. And this, it's important to know that even if if you lost money during the COVID years, then you will most likely 99% qualify. If you didn't lose money, we can still qualify you by showing that you could have made more money if it weren't for some of the negative, regulations in place during COVID. Like you couldn't have so many people come in, or you couldn't attend events, because that was forbidden or whatnot. Like if you were negatively impacted, we can still qualify you. So that's something to keep in mind. Mm-hmm. And those are the strategies. Yeah, for you today. So
now everyone's a nerd. This is so great. This is so important. I think like the framing of it, right, is that there's so much to consider. And like you said in the beginning, like we have our CPAs, we have our bookkeepers, we have our CFOs or fractional CFOs, we have a lot of people who work with us. And then there are these really specific strategies that are really around finding or reclaiming some money that we might not have known was available. So I really appreciate this because this is the level of strategy that one could and maybe should be thinking about. And because this is it. This is, we make our money, we save our money, we, try to pay what taxes are appropriate to pay. And then there's refinding money in places where we didn't think that that wasn't there. So I really appreciate it and appreciate you coming. And if you probably haven't already, Juliana, because you were talking, but as we get into the Q&A now, please, everyone can take down your information here and then also put it in the chat so that they can connect with you because this is really phenomenal. So thank you.
Thank you.